I would tell myself to focus and work hard. So get up every day, make one good day's worth of progress, and do it the next day, and do it the next day, and do that on repeat for a week, and you've accomplished a little bit. For a year, and you've accomplished quite a bit. And for 5 and 10 years, and you've accomplished a lot. So get up every day, focus, work hard, and take that step forward.
From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
Got Chad Daniel here on the show. Chad, welcome.
Thank you, Neil. Thanks for having me. Pleasure to be here.
I'm excited you're here. Say, for the audience to say, who are you? Where are you from? What do you do?
Wow. Short little questions, but I can elaborate.
Yeah.
So who am I? Chad Daniel. Live in Ankeny currently with my family. We have 8 and 10-year-old kids, and we've been in the Des Moines metro area for about 15 years. Who am I?
Yeah.
What were the other? Where am I from?
What do you do?
Where am I from? From Western Iowa. So I grew up in a small town called Glidden, near Carroll in Western Iowa. And what do I do? A variety of things. An overview would be I have a W-2 job, so a large corporation, and the last 6 to 8 years, I guess, I've been doing combinations of sales and product and portfolio management at that company. I do real estate stuff, and we'll probably talk a lot more about that stuff today. Other interesting things, like my wife has an Amazon FBA business, and I consider myself basically like on the board of directors for that, but we do that a little bit together, and fun little hobbies then outside of work. So hunting, fishing, biking, all that stuff.
All right. Talk to me. All right. You grew up in Glidden. When you graduated high school, what did you do?
Yes. So I graduated from high school and I went to Iowa State for engineering. Actually went into the agricultural engineering program at Iowa State, which I would recommend for anyone interested in getting a practical engineering degree. A lot of hands-on and educational stuff that helped me a lot today to understand structure in houses and supports and levers and leverage and mechanical systems, all that stuff. Wiring, we did wiring within the classes, which is unique to ag engineering. In mechanical engineering, you learn the theory of the electrons flowing in a wire. In ag engineering, you learn the theory and you get to do it. So that was great. Went to Iowa State for ag engineering. I started with Danfoss, the company I'm still working for, about 20 years ago then when I graduated, and started there in sales and engineering of hydraulic products, so hydraulic pumps and motors. They have a major location based in Ames, Iowa, close to us here. And I spent many years working there, now working from home in Ankeny. Partway through Danfoss, I got the itch to go learn more, and so I went back to school and got my mechanical engineering degree in control systems. So when I was in that program, I explained to people it was like the algorithm in your car that sets the cruise control.
Sure.
That was sort of the technology of the time. Now it's the algorithms in the self-driving cars that control them, and the algorithms that land rockets on little pads out in the ocean. So I learned about some of that stuff. I continued my journey with Danfoss, and in parallel, started getting more and more involved in real estate.
What was that point that you even got involved in real estate from the get-go?
Yeah, I started meeting together with some college friends, and that friend group grew a little bit over time, basically to stay in touch after we graduated. What we realized is, hey, we now have income, and a lot more income than we had as college students working for the summer. And we were trying to figure out where to invest that income. So that group started just meeting at the bar together once a month, to getting more and more formal and formalized, and eventually created a group where we co-invested money. And so we would put our funds together and we'd put our effort and brain power together to try to figure out where to invest. And we started by picking individual stocks and basically realized we were spending a whole bunch of time and energy and getting market average returns on average, which had we educated ourselves first, I think we would have learned that before we went through all the effort. But we learned that, built up some equity during that time because we could invest in stocks with very little capital. But to buy something like a single family home, you needed more.
Right.
At the time, maybe $10,000. So
Right.
not the same as today,
Right.
but more. So we did stocks. We transitioned to do tax lien and tax deed investing. I'm not sure if that's something you've done. You've done a lot in this space, Neil.
I'm familiar with it, but we've
Okay.
never executed that.
Okay.
Exactly.
It's its own interesting thing, which
Yes,
we
it
can
is.
spend 30 minutes
Yeah.
on. But at the end of the day, we didn't have enough capital to deploy at the sales. Background is you have to do quite a bit of research to whatever depth you choose prior to going to the tax lien sale. And then you deploy whatever money you have, or you sit there the whole sale and don't get to deploy all your money. Well, what was happening to us is we were getting opportunities to buy $10,000, $20,000, $30,000 tax liens, mainly on commercial buildings. And we could buy 0 or 1 of those, and then it's like done. It's done, gone. In Iowa, at least when we were doing it, all of the sales were on the same day. So we would have different representatives in different counties, and we're like, nope, we spent our budget. Everybody stop. No more bidding. But the basic challenge there was we didn't have enough capital to make all that fixed investment up front make sense, all the research. I guess another interesting point there, we did end up finding 4 different states that we would invest in, because many of these tax liens, you will put the money in, and I know you know this, Neil, but for the audience, you'll put your money in the day of the tax lien sale, and say we put $10,000 in to pay someone's taxes for them. We're guaranteed a 2% return per month on that investment, unless there's a default, and we won't go in that today. We can do a follow-up episode. But we're guaranteed 2% per month, but many, maybe 60 or 70% of those tax liens pay off within a week or two. Right. So great. You get the full 2% for the full month. So the rate of return in those 1 or 2 weeks is great, but now your money just sits around for a year. So we found 4 different states basically around the calendar year that we could go invest in to kind of keep our money rolling around. Wow. So that added some benefit, but also more headache and overhead and understanding those states and doing our research and stuff.
Are you still in tax liens today, or did you evolve out of that?
Yeah, we evolved out of that. We probably spent 2 years or something like that doing tax liens kind of part-time in parallel to starting to look at buy and hold rental real estate.
So at some point you built up capital enough to go, and cool, we got enough. We can at least buy a house, and then it kind of mushrooms a little bit, grows.
Yeah,
to buy more than one house.
Yes, the group was probably 7 people when we bought our first single family rental, and that was in Des Moines. We probably put something like $10,000 down. I'll say we paid $50,000 and we put $10,000 down, and those are roughly realistic numbers.
Year, roughly.
2010-ish. And these were distressed properties for sure. They weren't something I would have wanted to move into. But yeah, say we bought it for $50,000 and put $10,000 down. We would dedicate a weekend or a long weekend to all going there and doing a bunch of the fix-up work, and lots of painting and small repair sort of things. And then we had a property manager manage it for us. And then whatever it was, 4, 6, 8 months later, we had enough capital to go do that again. And we went from a phase where we were capital limited, so we could only buy a house, every 6 months or every 9 months or whatever, to a phase where we were time limited. The time limited part was that our time and availability to go look for properties was actually limited. So there were lots of properties on the market, and it was crazy. Our rule of thumb at the time was like, we could spend one day, go look at 5 properties on the MLS, and we could get one bought. And that was roughly sort of the purchasing funnel at that time. And the challenge was getting people to be able to spend half a day or 6 hours or whatever to go look at that many properties and then analyze them to see what makes sense to put the offers in and whatever. Fast forward to maybe 5 years ago, and we're not capital limited. We could find the time to go look at 5 properties, but we're really challenged to find the right properties, spending 6 hours looking on the MLS.
Five may not exist.
Yeah, right. Yes. Yeah. So it takes a lot more effort today to find what I would call a good property, and good is very subjective.
Sure.
Everyone has their own view on what good is, but that's certainly changed over time. We also find that in our investment group, we don't honestly have enough time to manage the portfolio that we have today. So we've worked on initiatives over the years to work on expense control or work on sort of managing the asset to make sure the house is staying in good condition. And we're really struggling to have the time in our lives today to even do those things to kind of keep up on our portfolio.
And that's largely at the asset management level, not at the property management level.
Yes.
Because
right.
everything for you guys is third-party property management.
That's right. Yeah. Yes. We have used third-party property management in our investment group really since we started buying single-family homes. A few of the members of that group, including my wife and I, have managed a few here and there due to certain reasons ourselves, but mostly we use third-party property management.
For some context, maybe the portfolio at its height had how many single-family doors in it?
Let's see. So the investment group probably had 30 to 35, probably 35, maybe 35 to 40 doors, probably about 30 to 35 individual units. Almost all single family, but a duplex or a triplex here and there sprinkled in. And then, so that's our investment group. And maybe we can come back and talk about the next evolution of that group in a bit. We also have members of that investment group that have used the concepts and knowledge that we've developed in the group and done the same thing themselves. So we use the group as sort of a testing grounds and a way to share our risk. And also we're doing something new, so we can all invest. Today it's 5 people. We can all invest 20% of the energy to go learn this new thing rather than 100% on our own. I guess 3 of the members of our current group have also invested in single family homes, again, mostly in Des Moines. And my wife and I are one of those members. And I count my wife and I as one. That's one of the 5 members. Most of the single family homes that her and I own are also here in the Des Moines metro area, and most are long-term buy and hold rentals. We've been a net seller of properties, so actually we've decreased our holdings in the investment group and personally over the last couple of years. And we can talk about why that is. We also ran into a situation where we were able to buy several condos up in the Spirit Lake area. And so we own about half the units in a complex there. And that's taken a lot of our time, energy, and resources basically to do the asset management and arguably more of the property management than we'd like to, but we do have third-party management there.
Talk to me about third-party management. Do you have everything, or historically, had you had everything with one in Spirit Lake? May be different too, but more one in the same geographic area? And then I want to talk about that property management. Just in case somebody out there has third party or is thinking about going third party, about what process you guys walk through to identify and interview and make decisions with a manager.
Yes. And Spirit Lake is separate and different. There are very limited options there. And at the end of the day, we essentially built our own option in a way. But if we move back to the Des Moines Metro, and I'm sure many other larger MSAs, there are a number of property managers to choose from. Our process has been to put together kind of a scorecard when we're looking for a new manager. And we ask lots of questions. I'm not going to try to repeat all those, but you can go find great lists online. You can talk to other people about those. Basically, what is the value they bring and what cost comes along with that? At the end of the day, those are the 2 questions for many things that we consume, but for property managers. In our investment group, we've had the model where we keep most of our properties with a primary manager and, 5-7%, something like that, with a second manager. And we've been open with the managers about, this is what we're doing. The reason we've done that is we wanted to make sure we were always sort of staying on top of what's the best offering around. So our second manager gave us an opportunity to test and build a relationship with a new manager. And we believe some of those managers saw us as a large potential customer, meaning the investment group's properties and also the individuals in the group, moving all those to that manager. And some managers saw us as people that had 2, 3, 5 properties with them, and that's not a big focus or priority. Over the 15 years or so in Des Moines, we have changed property managers a number of times. It's not frequent, but maybe the primary manager has an average span of 5 years, something like that. And it might be 2 and it might be 12, but maybe an average of 5 through that 15-year span.
What knocks a primary down and what pulls a secondary up?
Yeah, good question. We actually just made a large change about a year ago. And so I won't get into the specifics of that change because those managers know who they are and hopefully you're listening to this podcast. Sure. In general, what we value in a manager is treating work orders and residents as though you're the owner. And the inverse to that is receiving a work order on your plate as the manager from one of our properties. For example, that says the inspector says we need to replace the roof. And if you're viewing it transactionally, it's like, oh, got to replace the roof. I'm going to send this work order to the roofing person and get them started. Treating it as an owner would say, roof, that is a large investment. I wonder if now's the right time for that. Do we want to push back on the inspection? Do we want to wait till spring? Do we want to, I don't know, maybe change the structure of the house at the same time? Do we want to get 3 bids before we say yes? So like those types of things, I think owners do very naturally, but larger property managers tend to have workflows that don't always deal with that variation very well. So long answer, sorry. The short version is acting like you're the owner.
Yeah, we've had similar experiences with some property managers. They treat it like, and some of this is, yes, workflows. And I don't know what all the other reasons are, but they have incentives to spend your money. They do get comp, in some cases a percentage, in some cases a flat fee, in some cases they perform the work.
Yeah.
Right?
Yeah.
So at times there can be a misalignment of interests.
Yeah.
As it relates to that.
Yeah.
Right. So it does. I've lived that.
Yeah.
It's tough.
And you've mentioned some of the, the more under the table, maybe versions. Even at the basic level, the property manager has this constant flow of tasks coming into their inbox and they need to deal with them, right? Yeah. And it's a tough job. Yeah. I'm not saying it's an easy thing to do. It is a damn tough job, but they have this constant influx. And if they don't take care of those, people get upset. Bigger problems are caused with the inspector, for example, like you need to get these items done. And so even at the surface level, their motivation is to execute those activities quickly and efficiently.
Right. Yeah, no, you're totally right. Especially the bigger the operation, I mean, it is mind blowing about how much they have to do. It's largely a thankless job. It's a distinct challenge.
Hey, Iowa investors, this is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
Okay, so let's move forward a bit. You have become a net seller over the last handful of years of property.
Why? Yes. I'd say there are 4 things. 3 related to the market situation, and 1 is just our life situation. And I'd say our life situation, and I'll speak for myself and also other members of our investment group collectively, but we have other businesses, jobs, families, like life has gotten busier than it was 15 years ago. So that one's easy, and that's a personal thing, okay? In terms of the market, we were fortunate to be buying properties when, I'll say, property prices were low, interest rates were low, and rents were relatively high. So property prices, interest rates, and rents, those 3. And those have evolved over time. And property prices have increased. This is for sure not apples to apples, but that let's take that example, $50,000 house that I mentioned a few minutes ago. That's maybe, depending on the neighborhood, $150,000 or a $200,000 house today. Rent, boy, testing my memory, but rent maybe used to be $800,000. I don't know. If you have a better number, go ahead. But that's a ways back to remember. And now rent there is $1,200. Which certainly hasn't kept pace with the increase in home values, especially post-COVID here. And so that rent versus home price ratio has degraded quite a bit, in our opinion. I'll tell you why I qualified that with our opinion in a little bit. And then, of course, interest rates have increased significantly. So that combination, to me, doesn't lend itself to converting a bunch of single-family homes to rentals today, like we did in the past. And we did that in total probably with 100 or so houses. That was investment group, that was our own, and also with Turnkey Iowa, where again, we can dive into that, but basically we were creating ready to go rentals for other investors. So in those times, it made a ton of sense financially to convert single family owner occupied homes to rentals. Those three financial variables have changed. And in fact, we're doing the opposite now. So a tenant's lease ends, they want to move out. We will go into the place, make it retail ready. So make things a bit nicer than they were as a rental, and then sell it on the retail market. So actually we're doing the opposite now. We're converting rentals into single family owner occupied homes. And I mentioned the time constraint earlier. We're taking our equity from those sales now and investing in different syndications. One of them so far has been yours, but investing in different syndications.
You're right. It is extraordinarily challenging to just go buy a house, let alone, let's just say a deal, right? However you quantify that, a deal, and go get that thing to cash flow with leaving, I guess, let's say as little as cash in the deal as you can, right? I mean, of course, you'll pay cash, everything else, right? But let's call it, certainly compared to historical times, any time in the last 15 years, leaving a reasonable amount of cash in that deal to where you could really justify leaving the cash versus utilizing that cash someplace else. Yeah. It is. The asset values have gotten so far out of whack, and you're right, the rental values have not kept up, which means, there's largely imbalance, and it will not shock me if one of those two things has to change. Otherwise our net rental stock of, let's call it houses, not apartments, right? They'll just construct, will continue to fall. They're just going to come out, right? Because anytime we get the opportunity, we drew down our portfolio over the course of the last really 2.5 years. All of our C-class portfolio, going off memory, I think is now all gone. Maybe there's one left. For the exact same reason. Bottom at 50, you can sell them at whatever, 125 to 150, and you can barely get it to cash flow because it is darn challenging to manage, anybody for that matter, to manage an 80-year-old property and have stuff not break all the time.
Yeah. I totally agree with everything you said, Neil. Something that I didn't appreciate when we started investing in C-class properties is, I'm going to say it's a rigged game. And I say that because the tenants that move into those properties, if they're not renovated and nice, if you do a good job fixing them up, bring them up to maybe the B level, things are a bit different. But if you don't do a renovation on the property, the tenants that tend to end up in there will stop paying. Then it takes you a little while to get them out of the place. The place will be destroyed. You'll keep their deposit, but that's $1,000. And you missed a month or two of rent by the time this is all done. You have fix-up time, which is another... You guys probably do it better than we do, but is another month or two to get the place repaired and ready to go. And then you drop $10,000 into that fix-up because the place was destroyed. Most of the things I mentioned are the liability of the tenant, but the rigged game is that tenant doesn't have assets, may or may not have a job, right? Is it worth going after? Right. That's another discussion, and we've waffled back and forth. But it's a rigged game because they're liable for those things, but don't have to pay them.
And then what do? Get back in the merry-go-round again.
Yes, that's right. Try again. And that's the doom and gloom. We have looked at bad tenant turns, which is what I just described. Yeah. And that was like 2 to 4% for us every year. When we combined everybody's single-family properties together, is 2 to 4%. So it is very bad, but it doesn't happen to most properties most years, but it happens enough that it sure impacts the average return.
And that's largely a result of playing the C-class game. Because when you elevate my experience on yours, what's inside that portfolio, our B-class stuff is fantastic. They have appreciated well, like everything else. The rents have come up sharper in the B-class side than the C-class side has. Then, of course, in real dollars, but in percentages, I'm saying. And let's take care of it. Do you guys have B-class holdings? Had you had it in the portfolio? If so, what was your experience in that class?
Yeah, I'd say a few here and there. So probably not enough to put together like a true view. With the turnkey properties we would go in and do a really significant renovation. So you're talking a C, they range from probably C to C plus type neighborhoods. And we would go in and do a thorough renovation, roof siding, HVAC, like everything, and make it kind of a B plus, whatever property, but still in that neighborhood. And I've stayed in contact with a few of those investors, and I think the results have been better, probably between what we're describing as C and what you described as B. With our property in Spirit Lake, a lot of people think Spirit Lake, Okoboji, short-term rentals. We're not doing that in Okoboji or in Spirit Lake right now. So we do have traditional long-term rentals there. And that was very much a low C type of property when we purchased it, which was, I think, 2.5 years ago. And we've turned it into probably a B level. And the experience has gotten a lot better. So that's one complex as a data point, but it's hard.
No, it's challenging. Okay, so you've sold some things over a period of time. You make them market ready for somebody to move into it. They certainly pay the highest dollar amount of anybody that's out there in the marketplace. And you're moving into syndications. What had you guys decide on syndications?
Yeah, good question. It probably goes back 2 years ago. We have an annual planning session in our investment group, which is actually this coming Sunday. So I'm excited about that. We have an annual planning session, and we were confronted with the problem of, hey, what do we do with the equity that we're freeing up by selling these properties? Because great, you want to sell something when the price is high. Okay, that's one part of the equation. But now what do you do with that money? Yes, the now what question. And we looked at direct ownership of commercial properties like triple net leases, which would be, we believe, easier management, especially for the dollar amount that you can get deployed. We looked at disbanding the group. Like, we did our thing in real estate. It was successful. Should we disband? I'm trying to think of what else was on the list. Say syndications, but actually syndications can be a whole bunch of different things. Sure. So we've used that term broadly so far, but we've looked at a variety of syndications, including...
One can syndicate anything from real estate all the way to movies that get produced for Hollywood. I mean, almost anything. I've got a friend of mine who's in a syndication of whiskey barrels in Kentucky. I mean, you can syndicate just about anything.
Yeah, those are some examples I didn't know of, but thank you. Yeah, we looked into businesses, sort of brick and mortar businesses, manufacturing type businesses. We looked into e-commerce businesses. One of the members of our group is basically full-time e-commerce bike sales stuff. We looked into real estate, but again, if we drill down, then you look at real estate syndications. Okay, that's a whole nother family of different options. So I'm trying to zoom back up and remember, I don't think we looked at many other investment types, but ended up deciding on syndications from basically the leverage of our time point of view. We still want to invest in those syndications jointly. So if there's a $1,000 or $100,000 minimum, which are both quite common in real estate syndications, we'd rather split that 5 ways. At the end of the day, we don't split it 5 ways. We're all investing together, but let's say everybody had a fifth. We can buy 5 of those syndications instead of 1 on our own. And we have gone out and interviewed a number of different people providing syndications. That's also an interesting journey.
Tell me about that.
Yeah, there are. First, let's talk about like sort of marketing channels for syndication. So as soon as you think about investing in a real estate syndication, you open Facebook and there are like 20 ads. Yeah, screen after screen.
Think about it. Zuckerberg hears you. You just have to think about it.
Just think it. As soon as you think that thought, but it's amazing the number of marketing efforts that hit your inbox, hit your Facebook, LinkedIn, that sort of thing. But are those the places you want to invest with? Could be wonderful, be spending a ton of money on marketing and are less wonderful. Then there's also kind of engaging your network and word of mouth. People you know people, or people that you know have done syndications with different companies already. So kind of the network effect. So that's on the marketing side, and which is the best path. There are also so many considerations about geography, asset type, asset size, specific operators that I believe you can contemplate for a long time. At the end of the day, what we did was put together a list, and we got, let's say, good vibes and feedback and feeling about certain deals and others not. So we didn't define a geographic market and an asset type. We want to do multifamily in Indianapolis that's 100 to 150 units or whatever. We did not do that. We went much more with the different operators that we talked to and who we trusted. And when they had deals that popped up, we jumped on board.
Talk to me. I want to talk about two different levels, the deal level but first the sponsor level.
Sponsor, yes. Thank you for the word.
How did you, make a decision? What are the types of things one's looking for? So if somebody's at home and they're thinking, yeah, cool, I absolutely love real estate and I want to participate in real estate, or maybe they currently do participate in real estate, and syndications are an avenue I want to go down, because I don't know if we've talked about syndications, certainly not in this level of detail on the show at all. So this is great. When you're talking about going down that path, you're going to interview a general partner, somebody who's putting, at the forefront of that syndication, puts that whole thing together. What types of things are you looking for at their level, not the deal level, but as a general partner to go, yeah, that's a person I think we could see ourselves doing business with?
Yeah. In simple terms, I would say experience. Like, we want to make sure that we're engaged with someone that has the skills and the ability to get to success. So experience level was one basic part, and trustworthiness was the other basic part. So the experience, we believed, could allow someone to be successful. And the trustworthy part is making sure there's somebody that aligned interests and goals, no matter what the PPM, which is the 100-page document describing the relationship, no matter what that says. We wanted to find people that we believed wanted success for everybody involved in the deal, and not just healthy fees and commissions for them and not caring about the asset. Yeah. So sorry, that was simple, but those two simple things were our rationale. And again, they drive down.
Yeah, correct. Yeah. All right. So let's drop down a little. Now you've got a syndicator you've come to know, you've come to like, you've come to trust, and they have an opportunity. A lot of these people routinely have opportunities, right? It's been a little thinner in the last couple of years, but it's not just one and done. They're in the business oftentimes of producing opportunities to go buy a piece of real estate.
Yeah.
So inside an opportunity, a deal, what is it you're looking for that for you, or the crew, if you will, your group, makes it a green light versus a red light?
Yeah. On the theoretical side, we would like to see about 2/3 of the profits come from cash-on-cash returns. Not that those would need to be paid out to us, but to us, that builds confidence that the underlying asset is performing and can weather tough times.
Cash-on-cash returns being the operating income in the property versus an event such as a refinance or a sale.
Yes, correct. Yep. And that operating income, I guess, divided by our share. And that to us is maybe a throwback to our cash flow C-class property sort of mentality, where we want something that can at least cash flow on the pro forma. So in real life, it can at least break even cash flow. Like, we can be really confident it can break even. And if we go through tough times, that the property can support itself. And then the other 1/3 could be an event. So cash out refi or a sale or something like that. That's what we told ourselves. In practice, we haven't decided if we want that at a portfolio level. So would we be okay having, three syndications all with equal investments, and one is a full payout at the end deal? The other two are sort of full cash flow along the way deals. We haven't rationalized that for ourselves yet. So that's kind of the theoretical side. Now, the actual practice has been, we probably have 4 or 5 different sponsors that we feel comfortable enough that we would invest with. And then it comes down to, does that sponsor have a deal ready and available when we have the cash ready and available, which is a very practical thing, but matters a lot.
Just going back to the tax lien era, right?
Right.
It's the same exact thing. Hey, some of the returns can be great, but it's not available every week.
Yes.
Right.
Right. So that's a very practical thing. And then we have, I'd say, unspoken disqualifiers. So we haven't made a list of these, but we've had deals where we trust the sponsor and the timing would have worked out. But you know what? This is a C-class apartment building in Des Moines. Not that that can't be a super successful deal, but we all have a lot of exposure still to C-class single family in Des Moines. So let's get a different geography or a different asset type. So that's the way the practice has worked. Excuse me.
It makes total sense. Does where we happen to be in a real estate cycle, does that have you also giving thought to putting brakes on anything with additional C-class exposure?
I don't know. You can help me with the numbers and the valuations. Sorry, let me back up. Was your question related to single family homes or syndications?
Either one, just any additional C-class exposure, whether it comes in the form of multifamily or comes in the form of a house.
Yeah. C-class houses, I'd say we're out and we're a net seller. We're demonstrating that we're leaving that area. We're leaving it because we believe those three things, the price, the rents, and the interest rate, don't make sense as much now. From a syndication point of view, and here's where you can help with the multifamily valuations, if you know. I think there was a significant drop in multifamily valuations maybe 18 months ago or 1 to 2 years ago when interest rates went up. And so today's values maybe 20-30% lower than they were. And you can provide a calibration if you would share a different
I don't know
number.
the exact number, but I would sure think that yes, they for sure are lower.
In that range.
When interest rates double, they just don't pencil otherwise. My question comes from the real estate cycle. The idea being that I have a hard time thinking we're getting some sort of quantitative easing, or have a hard time thinking that rates are going to magically reduce by something significantly measurable, thus catapulting the asset value upward.
Yeah.
So what are you left with? You have a C-class portfolio, which you're only getting cash flow out of, because the idea that some significant event in a near future is non-existent.
Yeah, sure.
Versus, if you're on the run up in whatever, 14, 15, 17, 18, 19, 2020, with the way things were going, you could have done extraordinarily well in C-class multifamily because of asset values were appreciating so rapidly.
Yeah.
That's what prompted that question.
And the values have, here I'm going to predict the future, which is terrible, but it's likely the values have not dropped. I mean, they have dropped significantly. If you told me something was going to go down in price 20 or 30% and I could buy it next year at that price, I would probably take that deal. But let's say multifamily has gone down 25%. We might say, that's not enough to make it appealing for the next 5 to 10 years.
Your cash on cash returns may have still been higher 4 years ago, buying the asset at an elevated level versus
with the
today
debt
and 30% lower because of where your debt is today.
Yeah, right.
I agree with you, and there's a number of people who would echo that, to go, still can't justify it.
Yeah.
We're going to sit and wait.
If you're a house flipper, execute the BRRRR strategy or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
What are you most excited about in 2025?
So we've touched on syndications, and I've mentioned that we're in a deal with you, Neil. We can't wait to see what opportunities you guys dig up and are looking for investors for.
No pressure, Neil.
No pressure. So that would be good and exciting.
Yeah.
And honestly, we really have appreciated working with you and Ava. It has been great. It's been a good experience. On the walk-in to this podcast room today, I asked Ava, hey, again, what's the name of the place that we invested in? I don't even know the name of it. That's how involved or not involved I am with the day-to-day operations. That has been wonderful. Thanks for the updates. You guys are doing great.
It's been a very good holding for us, and I think they're still very positive with us. What are we, 6 months or so in? It's been very good. Yeah.
What am I excited about? So I actually have an interesting opportunity at my W-2 job right now that I'm working through together with my wife and potential leader, where I'm considering going from my part-time position, which I've had for about 3 years now, back to maybe full-time. And so that's interesting and exciting. The net impact of that would be less time for real estate, because what drove that part-time situation was real estate growing sort of as a side hobby and hustle and becoming a big thing. And so things might switch back a little that direction, which would drive even more syndication work and focus.
When you say part-time, how many?
Yeah.
What does part-time mean?
I guess officially 75%.
Okay.
It's still a salaried position, and I think most, if not all, salaried positions are pretty flexible, and there are ups and downs to that nominal level. And then in practice, and a lot of people ask, how's that work day to day, week to week? In practice, I work a lot with people in Europe. So I start my day super early with W-2 job stuff. I'm at my computer in my home office doing W-2 stuff up until early mid-afternoon, wrap that up, and then switch over and catch up on some real estate related things. And I do that 5 days a week because a lot of people are like, oh, do you have Fridays off or whatever? And sounds like fun and games, but this is me switching from one job to the other job at some point in the day.
That's going to be, you've been contemplating this. I know you've been giving thought to that and making some decisions about how that's going to come together. Well, it's exciting to see how it all comes together for you.
Yeah, let's see. I don't know what else I'm excited about in 2025. We will see.
How about in real estate? What are you most excited about in real estate in 2025? We've got a new president going in place, and as we record this, in just a matter of days.
Yeah.
I'm just trying to think.
Yes.
PI was just came out either, I want to say yesterday or today, but I think it was yesterday. Lower than expected. The stock market reacted very positively. So there's additional talks now, just sheer speculation more than anything about, hey, we might get more rate cuts than we originally thought. I suspect it's way too early to make that prediction.
I'm having a hard time finding optimism in real estate in 2025. And I suppose that comes from my view of interest rates probably holding around steady. Now, will they go down a bit? Sure, maybe, but not down to where they were a couple of years ago. And we might not see that again for decades. So I'm not terribly optimistic about that. I'm excited to see what happens with the new presidency. I'm not saying that's good or bad, but it's an exciting journey we'll be on here for the next 4 years. Real estate values, I'm concerned about. Not so concerned that we're liquidating everything as fast as we can, but a modest appreciation I would count as a win for Des Moines single-family real estate in 2025.
Ready for the final 3 questions?
Sure.
If you had one piece of advice for your 20-year-old self, what would it be?
It's really easy to say buy more of those houses at that time, but there are always limitations. So I think that's a bit unfair. I would tell myself to focus and work hard. So get up every day, make one good day's worth of progress, and do it the next day, and do it the next day, and do that on repeat for a week, and you've accomplished a little bit. For a year, and you've accomplished quite a bit. And for 5 and 10 years, and you've accomplished a lot. So get up every day, focus, work hard, and take that step forward.
2 books that changed your life.
Rich Dad, Poor Dad, just from a general thinking about assets and liabilities point of view. I don't think I need to say more about Rich Dad, Poor Dad. A really interesting one that connects back to the discussion we've had today. It was one of Jim Collins' books, and I think it was Great by Choice, maybe Good to Great. But there is a chapter that talks about firing bullets and then cannonballs. And it's an analogy and a short story here. Imagine you're out on a battleship, and it's a sailboat back in the 1700s, 1800s, whatever. But it's a sailboat, and you have cannons, and you encounter another battleship. There are a couple of different philosophies you can take. One is to load up all the gunpowder and fire your big cannonballs at the other ship. The other is to get your little cannon out and fire that 3, 4, 5, 10 times until you get the trajectory set and then go all in. And the connection back to real estate is that after you've tested something, you've analyzed it, you've tested it in a few different ways, you've bought a house or two or a syndication or two, and you've seen what the impact was. You see if that bullet was a hit or not. Now it's just one bullet. Every bullet can stray different directions, right? But after you see that's a success, you also have to be prepared to fire the cannonballs in that direction. Practice, 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 see how it works out, and then put a bunch of chips in the direction that was successful.
Cast away on an island for a year. You can only get 3 pieces of data about your real estate business each and every month. What 3 things must you know to know how your business?
So I've heard this question in your other podcasts, but I haven't come up with a nice answer, Neil, because we have so many different facets of what we're doing. The best I've come up with is sort of all-encompassing, and that is, how many purchases do we have in the pipeline? So we're working to get to close, whether that's a syndication or a flip property or a turnkey in the past or a buy and hold rental. So it kind of applies to all those. How many properties are we currently renovating? So that's the middle phase. And then how many properties are we selling or dispositioning?
Great. Yeah, lots of questions. This has been a fantastic conversation. I appreciate being here. What's one question I did not ask that I should have asked?
So Chad, how has real estate performed in the years you've been investing?
Let's do it.
Let's do it. Okay. And I'd like to ask you the same question,
Okay.
if that's fair. The market has changed a bunch over time. We've talked about what we've been investing in the past. We bought for cash flow, and we went in investing very little at the front end to make the property nice and attract good tenants. With that, we've had cash flows that are basically zero because of the unfair game, because of maintenance and repairs, because of systems that are just worn out in the houses and we're upgrading. So we invested for cash flow, and oh my gosh, we killed it with appreciation, like 20 to 30% return on equity year over year because of appreciation. And that's been phenomenally successful. We aimed for cash flow and we got a ton of appreciation. And for that, I'm very grateful and thankful. And real estate has worked very well in building wealth and creating equity that can be invested in, again, in real estate or in other things to produce income.
It's been a fantastic asset, has it not, for several years. My backstory is I started in as an agent selling homes, brokering homes for years and years and years and years, and I probably stayed in that business too long from a practicing standpoint. 2010, I was still in the business, and I had an exceptional year, best year I ever had as a real estate agent. But I should have taken the blinders off and seen the opportunity that was around me. Eventually I did, but it took a few years. And it has been exceptional. And I'm in for us, when we analyze a deal, it depends on the asset, of course, the asset class, but oftentimes it's what's our cash on cash return? What's the intent? What's the target there? What are the tax benefits? And what's the appreciation look like? Because there's some deals on the triple net side. I've got, one of the very first ones I bought. I think we've got a tenant in there. If you add up all their options, it's probably like a 17-year deal. And so I'm suggesting that this is a cash flow basis only because I don't get to realize because of the bumps that take place in the lease. The only thing outside of that is what's a cap rate, because I don't get it. I have no ability to move that income. 15 or 17 years, right? And there are other ones where you got a couple of years and you can do the work and you can earn that, right? So that's a component that goes into that, making those decisions. For me, the view of debt, if you can view debt ultimately as an asset and not a liability, I think if you have the right mindset as it relates to real estate, that could do wonders for you. Because I've got a bunch of debt out at 3 to 4%, sub 4%, and I can tell you, I don't view any of that as a liability. I view it all as an asset because if your debt's at 3% tax deductible and inflation's at 3%, I'm net positive by the time you take out the tax piece on that whole thing. So it has done exceptionally well. And you're right. Home price appreciation has done, for us, it's never a decision when we're buying a deal because the appreciation, outside of flipping a property, but I'm saying if you're going to buy it and put it in a portfolio as a rental, it doesn't pay the bank, right? Appreciation doesn't pay the bank. It pays you, and ultimately, it's a great cherry for doing the things operating the property wonderfully well. But if values increase 5% a year, let's call it, and you put down 25%, well, you've got leverage on that 5%. So really, your rate of return is 20% a year. Yep. That makes sense. Yep. I'm giving you a lot of words here. Yep. So ultimately, sum it up to say it has been It's been exceptional. My belief is all things work for those who work. And you said it when I asked you, when you give your advice to your 20-year-old self, it's right in there. Focus and go to work, because that knowledge and everything you're doing in that focus and that work compounds. Chad, I'm going to give you the last word here. I'm going to ask you one more question.
Okay. Well, thank you so much for having me on. And also, at Thanksgiving time, our investment group and I shared this with you and Ava, but we're really thankful to have met and been in contact with you guys. You're doing so many awesome things. And I picture myself sometimes like, oh, what if this W-2 thing hadn't had worked as well as it did, or I didn't like it or whatever, which is all water under the bridge. Like, I think I'd want to be like Neil in real estate. So that's awesome.
It's extraordinarily kind of you. And I value, we've known each other for, period of time, long before you came into syndication. I appreciate the work you do and the work you've done over a period of time. Meeting the fellows group, just a terrific group of guys. You asked very insightful questions. It's fun to be able to connect and have people in our syndications who they can ask questions, because some of the questions aren't just like, gotcha, right? It's, did you think about this? Oh, cool. Did we think about this? Could we think about this differently? Could we go deeper? Right? Because, and it works really well when you have aligned interests, as you said earlier. Ted, for people who want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
Yeah, I'm a guy about deep and sincere conversations, to be honest. And so my Facebook and Instagram, whatever, is low. The best way to contact me, if you do want to talk about something, is probably email. And it's chad@turnkeyiowa.com. I assume that can make it in the show notes. That's the best place, and I'm totally open to giving back. We've had a lot of help along the way and a lot of success in real estate. If there's something you're wondering about, something we can provide a different angle or perspective on, or do some sparring on, be happy to help and engage in that.
Yeah, I sincerely appreciate you taking the time today to have this conversation. It's great, and it's a unique perspective from everything that you and the group have gone through, and really how it's evolved over a period of time, and your unique perspective on things. So I appreciate sharing.
Very good. Thank you.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to legacyimpactinvestors.com, click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.